Hello, good afternoon. Greetings to everyone, and welcome to our lecture series in Introduction to Agriculture Policy and Development in the Philippines. So, for the continuation of our discussion, this will be the part two of Unit 5 in Agricultural Financing and Support in the Philippines. Okay, so let's proceed. Okay, so kindly like, follow, and subscribe for more video updates related to our subjects. So, as part of the continuation in the government initiatives and support programs, so we were going to discuss about the Agricultural Credit Policy and Council and its role in agricultural financing. So, the ACPC is a government agency in the Philippines tasked with formulating and implementing the policies and programs that aim to improve access to credit for smallholder farmers and fisher folk. Established under the Executive Order number 113 series of 1987. And the ACPC plays a crucial role in facilitating agricultural financing and promoting rural development in the country. So, next is the Agricultural Guarantee Fund Pool and its contribution to risk management in agricultural lending. So, the Agricultural Guarantee Fund Pool is a financial mechanism designed to mitigate the risk associated with agricultural lending and it improved access to credit for farmers and agribusiness. So, the AGFP serves as a guarantee mechanism that provides credit enhancement to financial institutions such as banks and microfinance institutions to encourage them to lend to farmers and agribusiness. By offering guarantees on agricultural loans, the AGFP helps reduce the credit risk faced by lenders and thereby increasing their willingness to extend credit to the agricultural sector. Next, the Development Bank of the Philippines and the Land Bank of the Philippines. So, the roles and programs in our agricultural financing. So, the Development Bank of the Philippines and the Land Bank of the Philippines are the two major government owned financial institutions in our country. So, both banks play a significant roles in providing a financial services and support for agricultural development. So, in our country, through various programs and initiatives. So, first, the Development Bank of the Philippines. Its role is the premier development financing institution tasked with promoting economic development and growth, particularly in underserved and priority sectors, including our agriculture. Then, the Land Bank of the Philippines. The LBP is the country's leading government financial institutions that is dedicated to serving the need of rural communities, our farmers, and agrarian reform beneficiaries. And it plays a crucial role in promoting the inclusive growth and poverty reduction in the agricultural sector. Next, let's talk about the microfinance and rural banking. The institution and their role in providing financial services to our rural communities plays a crucial role in providing these financial services, particularly to the individuals and small businesses who have limited access to the traditional banking services. So the following are some of the overview of the role of microfinance and rural banking, serving rural communities. First, access to financial services. The microfinance bridge the gap in financial inclusion by providing a what we call range of financial services to our rural population. And these people who may not have the access to the formal banking institution. So this serves their services includes savings, loans, insurance, money transfer, and other financial products that is tailored to their specific needs of rural clients. Then, empowering our rural entrepreneurs. The microfinance empower rural entrepreneurs, including our farmers, artisans, and small scale traders, and micro entrepreneurs by offering them access to credit for income generating activities and business expansion. And by providing the small loans and microcredit facilities, the microfinance enable rural entrepreneurs to invest in productive assets, purchase equipment, and start or grow their businesses. Then, let's proceed to the promoting livelihood diversification. The microfinance support livelihood diversification in rural communities by financing a wide range of economic activities beyond agriculture and including the small scale manufacturing, handicrafts, retail trade, and service oriented businesses. And by diversifying their sources of income, the rural households become more resilient to economic shocks and seasonal fluctuations in agricultural incomes. Then, the building financial literacy and capacity. So, the microfinance play an essential role in building financial literacy and capacity among rural clients, educating them about the basic financial concepts, budgeting, savings, and responsible borrowing practices. Through financial education and training programs, the MFIs empower the rural client to make informed financial decisions and manage their finance effectively and improve their economic well-being. Then, promoting the social and economic development. Through the microfinance and the rural banking, it contributes to a social and economic development in our rural areas by fostering the entrepreneurship, creating employment opportunities, and stimulating the local economic growth. By providing access to finance, the microfinance helps unlock the productive potential of our rural communities, reduce the poverty, and promote inclusive development. And then the adapting to local context and needs. So, through the microfinance, operate on the principles of client centricity and financial inclusion, tailoring their products and services to the unique needs and preferences of rural clients. They adopt flexible lending methodologies, group lending models, and community based approaches that are culturally sensitive and responsive to the socio-economic realities of our rural communities. Then the partnerships and collaborations. Through the microfinance, they are often collaborate with our government agencies, even our non-governmental organizations, and also the development organizations and other stakeholders to leverage the resources to share the best practices and scale up their impact. Through the strategic partnership, the microfinance expand their outreach, enhance the service delivery, and also address the systemic barriers to financial inclusion in rural areas. Then let's proceed to the part two of the microfinance in rural banking, which is the importance of our microfinance in promoting the financial inclusions among our smallholder farmers. Since the microfinance plays a pivotal role in promoting the financial inclusion among smallholder farmers, particularly in developing countries where access to traditional banking services is limited. Financial inclusion refers to the availability and the affordability of our financial services to individuals and communities, regardless of their socioeconomic status. So, here are several reasons why microfinance is important in this context. First is the access to capital. So, smallholder farmers often lack access to formal institutions due to factors such as low income, lack of collateral, and remote locations. So the microfinance institutions provide them with access to small loans and savings account and other financial services tailored to their needs. And this Financial resources enable our farmers to invest in seeds, fertilizers, equipment, and other input necessary to improve our agricultural productivity. And then the risk management. Agriculture is inherently risky due to factors such as weather fluctuation, pests, and market volatility. Microfinance helps smallholder farmers mitigate their risk by providing them with insurance products and savings mechanism. With access to microfinance, our farmers can really better their coping with these challenges with unexpected losses, and they can be able to stabilize their income. Then the income generation. Microfinance truly empowers the smallholder farmers to diversify their sources of income and beyond agriculture by providing access to credit. The institution will truly enable our farmers to invest in alternative income generating activities such as the small businesses, our livestock rearing, and off farm employment. So this diversification enhances the household resilience and reduces the dependence on seasonal agricultural income. And then our capacity building. The microfinance institutions often offer financial literacy training and advisory services to their clients. And these capacity building initiatives equip our smallholder farmers with the knowledge and skills that are needed to manage their finances effectively, make informed investment decisions, and improve their overall financial well being. Then the women's empowerment. So, in many rural communities, women play a crucial role in agriculture and household management. And in microfinance, it really plays a vital role in promoting the gender equality by extending the financial services to our women entrepreneurs and our farmers. By empowering them with access to credit and financial resources, microfinance contributes to their economic empowerment, decision making authority, and social inclusion. And also the poverty alleviation. By facilitating access to financial services and also fostering the entrepreneurship among our smallholder farmers, microfinance contributes to poverty alleviation and economic development at the grassroots level. Access to credit enables farmers to increase their productivity, generate higher income, and improve their living standards over time. Okay, so in conclusion, in our microfinance and rural banking, microfinance plays a significant role in promoting our financial inclusion among our smallholder farmers by expanding their access to capital. At the same time, they can be able to mitigate the risk and also diversifying your income, building the financial capabilities that is somehow very vital to our economy, and empowering women and alleviating poverty. By addressing these unique financial needs in our rural communities, the microfinance institutions truly contributes to inclusive growth and sustainable development in our marginalized communities. Okay, let's proceed to the challenges. Well, there will always challenges in every area, and one of this is the seasonality and cash flow. So we need to understand that the agricultural income is often seasonal due to um, its characteristics of our commodities, with farmers experiencing what we call fluctuation in cash flow throughout the year. And this poses a challenge for microfinance institutions in terms of how our farmers could be able to repay our um, um, microfinance institutions, and at the same time to have a liquidity management. So the collateral constraints. Smallholder farmers typically lack traditional forms of collateral, such as land titles, which are often required by the formal financial institutions. This makes it difficult for farmers to access the credit from conventional sources and increases their reliance on microfinance. And then our risk management. Agriculture is subject to various risks, including weather related disasters, pests, diseases, and market volatility. So the microfinance institutions need to develop effective risk management strategies to assess and mitigate the risk associated with agricultural lending while ensuring the sustainability of their operations. And then the limited financial literacy. So many smallholder farmers actually have a limited financial literacy and may lack knowledge and skills that are needed to manage their loans, savings accounts, and other financial products that they avail. So this underscores the importance of financial education and capacity building initiatives within the microfinance programs. And at the same time, in our infrastructure um, and technology constraints, in the rural areas with limited access to infrastructure, such as roads, electricity, and telecommunications, it hinders the delivery of financial services and the adoption of innovative technology for our agricultural finance. So these are some of the challenges for our microfinance. So let's take a look about the opportunities. Well, we do have a technology and innovation, advances in financial technology, um, fintech. Its present opportunities to enhance the delivery of our microfinance services to rural areas. Mobile banking, digital payment, and online lending platform can already improve the accessibility, reduce transaction cost, and streamline the loan disbursement and repayment process. And then our value chain financing. In the value chain financing, this involves providing financial services to all participants in the agricultural value chain, including farmers, input suppliers, aggregators, processors, and distributors. By financing the entire value chain, the microfinance institutions can promote collaboration, improve market linkages, and enhance the efficiency and sustainability of agricultural production systems. And also our social impact investing. So there is growing interest among investors, our philanthropists, and development agencies in supporting the microfinance initiatives that truly aim to promote the financial inclusion, poverty reduction, and sustainable development. Social impact, investing in that provides opportunities to mobilize the funding for our agricultural microfinance projects and also to scale up the impact oriented interventions. And also in our policy and regulatory support. Governments play a crucial role in creating and enabling the environment for our agricultural microfinance by implementing these supportive policies, regulations, and incentives. So the policy measures such as agricultural credit guarantees, interest rates, subsidies, and rural infrastructure development can facilitate the growth of microfinance institutions and enhance their outreach to underserved rural populations. And then our partnerships and collaboration. So there is an opportunity in collaboration among our stakeholders, including the microfinance institutions, governments, NGOs, agricultural cooperatives, and private sectors that act as a catalyst. And they can leverage the complementary resources, their expertise, and network to address the what we call multifaceted challenges. It's a really broad challenges actually in our agricultural industry and especially specifically in our agricultural finance and promote this inclusive and sustainable development. So, in conclusion, while our agricultural microfinance faces really significant challenges, there are also ample opportunities to innovate, collaborate, and leverage technology to improve the access to financial services for our smallholder farmers and to unlock the potential of agriculture as a driver of economic growth and poverty reduction. Okay, so let's proceed to the public-private partnership in agriculture financing. So the importance of collaboration between the public and the private sector is crucial for addressing the complex societal challenges. So we have a very broad scope and promoting the economic development and achieving the sustainable growth. So let's take a look. So first, let's take a look about the resource mobilization. The public and private partnership enable the pooling of resources from the both sectors to finance projects and initiatives that would be challenging for either sector to undertake independently. So by leveraging public funds with private investment, government can maximize the impact of limited financial resources and they can be able to catalyze investment in critical sectors such as the infrastructure, healthcare, education, and our renewable energy. And then in our innovation and expertise, collaboration between the public and private sectors uh, fosters the innovation and knowledge, sharing by combining the technical expertise, creativity, and market driven approaches of private enterprise with the regulatory oversight, public service, that ethos, and social mandates of government agencies. The public and private partnerships often lead to the development of a what we call cutting edge technologies, business models, and the policy solution that address the pressing the societal needs and drive economic growth. And then the risk sharing and management. So the public private partnerships enable the sharing and mitigation of risk associated with the large scale projects and investment. And by aligning the incentives and the sharing of responsibilities between the public and private sectors, the public private partnership help distributes what we call risk more equitably and create a conducive environment for a long term investment and sustainable development. So it enhances also the service delivery. So the collaboration between the public and private sectors enhances the delivery of essential services and infrastructure by harnessing the efficiency and innovation and customer-centric approaches of the private sector while ensuring the accountability, equity, and social inclusion through government oversight and regulation. The PPPs have been instrumental in improving the access to healthcare, education, and transportation, and utilities in many countries around the world. And it also have the capacity in building and institutional strengthening. So the public-private partnerships contribute to the capacity building and at the same time, institutional strength of both sectors by promoting the cross-sectoral collaboration, the knowledge transfer and skills development. So, by engaging in joint ventures, capacity building programs, and policy dialogues, the governments and the businesses can enhance their governance structure, operational capabilities, and regulatory frameworks to better address the emerging challenges and opportunities in a rapidly changing global landscape. So, in conclusion, the collaboration between the public and private sector is truly essential for fostering the inclusive and sustainable development, unlocking the synergies and maximizing the impact of investment and initiatives at addressing the complex societal challenges and advancing the shared prosperity. Then let's take a look about the joint initiatives for our agricultural credit and investment. So joint initiatives for the agricultural credit and investment, it involves a collaboration between the various stakeholders and including the government, the financial institutions, development agencies, and agricultural organizations. This will promote the access to finance and at the same time enhance the agricultural productivity and support the rural development. So number one is the agricultural credit guarantee scheme. So the government often establish credit guarantees scheme to mitigate the risk associated with agricultural lending. And through this initiative, it encouraged the financial institutions to extend their credit to our smallholder farmers and agribusinesses. So these schemes typically involve a partnership between our government agencies, banks, and development finance. Institutions with the government providing partial or full guarantees on agricultural loans. For example, the Agricultural Credit Guarantee Scheme Fund in Nigeria. So this reference provides credit guarantees to participating banks and enabling them to extend loans to farmers and agribusinesses that reduce the risk. So, in agricultural value chain financing, it involves financing the entire agricultural value chain from the input, supplier, and at the same time going to the farmer, to the processor, traders, then to the exporters. So by partnering with stakeholders across the value chain, financial institutions can tailor their financial products and services to meet the diverse need of the participants and facilitate access to credit insurance and other financial instruments. So, for instance, in the warehouse receipt system in Uganda that enables the farmers to access credit by using the warehouse receipt as collateral. So, thereby improving market access and reducing the post harvest losses. Then, the public private partnership in agriculture finance, as we tackled in previous slides. The government, financial institutions, and the development agencies often collaborate through the public-private partnership and to promote the agricultural finance and investment. So the PPPs facilitate the mobilization of resources, expertise, and technology from both the public and the private sectors to address the challenges such as limited access to credit, inadequate infrastructure, and market inefficiencies. And for example, the Smallholder Agricultural Credit Fund in Kenya is a PPP initiative that provides financing to smallholder farmers through a consortium of banks, microfinance, institution, and development partners, supported by their government guarantees and technical assistance. And then the risk sharing mechanism and insurance programs. The government and financial institutions may partner to develop a what we call risk sharing mechanism and insurance programs that protect farmers and agribusiness against the various risks, including crop failure, the price fluctuations, and natural disaster. By sharing the risk associated with the agricultural production and marketing, these initiatives encourage the financial institution to extend credit to farmers and enhance their resilience to shock. It's really the shock that caused by these uncertainties. For instance, the weather index based crop insurance scheme in India that provides insurance coverage to their farmers against weather related risks with premium subsidies by the government and claims settled based on the predefined weather parameters. So, in conclusion, joint initiatives for our agricultural credit and investment to really play a vital role in expanding the access to finance, promoting sustainable agricultural development, and improving the livelihoods of smallholder farmers and rural communities. Okay, so next is our example of successful public-private partnerships in agricultural financing. So in the public-private partnership in agricultural financing in the Philippines have played a significant role in expanding access to credit, improving the agricultural productivity, and promoting the rural development. So the following slides are some of the example of successful PPPs in agricultural financing in our country, in the Philippines. First is the Agricultural Guarantee Fund Pool. So the Agricultural Guarantee Fund Pool is a PPP initiative that was being established by the Philippine government in collaboration with the private financial institution, and it aims to provide a credit guarantees for our agricultural loan. The AGFP aims to reduce the risk associated with agricultural lending and encourage banks to extend credit to smallholder farmers and agribusiness enterprises. And by leveraging the government guarantees, participating banks can expand their agricultural loan portfolios and reach underserved rural communities. Then our agribusiness credit and financing program. The Agribusiness Credit and Financing Program is a joint initiative between the Philippine Department of Agriculture and through our private banks to provide credit and financial services to smallholder farmers, to our fisher folks and agribusiness enterprises. Under the Agribusiness Credit and Financing Scheme program, the DA collaborates with the partner banks to offer this subsidized interest rates and flexible loan terms, and technical assistance to the eligible borrowers that engage in priority agriculture sectors such as rice, corn, high value crops, and fisheries. And then our Agricultural Credit Policy Council is a government agency that is responsible for formulating the policies and programs to promote agricultural credit and financing in the Philippines. The ACPC works closely with private financial institutions, rural banks and cooperatives, and microfinance institutions to expand access to credit for smallholder farmers and rural entrepreneurs. And through the ACPC's credit programs and incentives schemes, the agricultural stakeholders can access financing for production, post harvest, into their marketing, and into their agribusiness venture. And then our Philippine Crop Insurance Corporation. So this is a government-owned and controlled corporation that offers agricultural insurance products and risk management services to farmers and agricultural stakeholders across the country. So the PCIC collaborates with our private insurance companies, cooperatives, and agricultural organizations to provide affordable insurance coverage against crop losses, natural disasters, and other perils affecting the agricultural production. And by partnering with private insurers, the PCIC expands the reach of its insurance program and promote the financial resilience among our Filipino farmers. So in conclusion, this example are some of the illustration that how the private partnership is very important in our agricultural financing in the Philippines, which it really contributes to enhancing the financial inclusion and fostering a what we call sustainable agricultural development and improving the livelihood of our rural communities. Okay, next is our innovation and technology in agricultural financing. So the role of technology in improving the access to finance for farmers, the technology somehow play a crucial role in improving the access to finance for farmers by overcoming barriers such as geographic remoteness, lack of collateral, and limited financial infrastructure. Here are several ways technology facilitates access to finance for farmers along with our references. So, digital payments and mobile banking. So, the digital payment systems and mobile banking platforms enable our farmers to conduct a financial transactions such as savings deposit, their loan repayments, and money transfer using mobile phones or electronic devices. By reducing the need for physical bank branches and paperwork, the digital payment solutions enhance the what we call convenience, the efficiency, and the accessibility of the financial services for our farmers in the remote rural areas. And then the online lending platforms and peer-to-peer lending. So the online lending platforms and the P2P lending networks connect farmers directly with our lenders and investors, bypassing the traditional financial intermediaries and streamlining the loan application and approval process. So it makes it even more faster. Through the online platforms, the farmers can access the credit quickly, conveniently, and at competitive interest rates based on their credit worthiness, the agricultural production history, and future income projections. Then the blockchain technology and smart contracts. So the blockchain technology enables the transparent, secure, and immutable recording of financial transactions and contractual agreements. So it reduces the risk of fraud, corruption, and data manipulation in agricultural finance. The smart contracts powered by blockchain automate the execution and enforcement of loan agreements, insurance policies, and supply chain transactions, enhancing the trust, accountability, and efficiency in the financial transactions. And then the data analytics and credit scoring models. So the data analytics and machine learning algorithms analyze a vast amount of data, including the satellite imagery, the weather patterns, soil conditions, and market trends, to assess the creditworthiness and risk profile of farmers and agricultural enterprises. By leveraging the alternative data sources and predictive analytics, the financial institutions can develop more accurate credit scoring models and tailor financial products to meet the unique needs and preferences of agricultural borrowers. Then the digital agri-tech solution and value-added services. So the agri-tech startups and digital platforms offer a wide range of value-added services to farmers, including market information, the weather forecasts, agronomic advice, and input supply chain management. By integrating the financial services into digital agri-tech solutions, farmers can access credit, the insurance, and savings products that are customized to their specific crop production cycle, input requirements, and marketing channels. So, in conclusion, the technology driven innovations have the potential to revolutionize the agricultural finance. And by expanding the access to financial services and reducing the transaction costs. And at that uh, idea, it also mitigate risk and also empower our farmers to make informed financial decisions. And by harnessing the power of technology, the policymakers, financial institutions, and agri-tech companies can catalyze the inclusive and sustainable development in the agricultural sector. So, in closing, I hope this video lecture on agricultural financing and support in the Philippines has provided you with valuable insights into the intricacies and challenges of supporting our agricultural sector. And as we explored the various financing mechanism, government initiatives, and private sector interventions, it's clear that addressing the needs of Filipino farmers, it requires a multifaceted approach from microfinancing to large scale investment, from infrastructure development to market access. So each aspect plays a crucial role in what we call bolstering the agricultural productivity and rural livelihoods. So, moreover, understanding the unique context of the Philippines with its diverse agricultural landscape, and socioeconomic dynamics, underscores the importance of tailored solutions and collaborative efforts among stakeholders. As we strive to enhance the agricultural financing and support system, so let us remain committed to fostering the innovation, sustainability, and inclusivity in our approach. By empowering our farmers, improving access to resources, and fostering the conducive environment for growth, we can pave the way for a resilient and thriving agricultural sector that not only sustains livelihoods but also contributes to the nation's food security and economic development. Thank you for your attention and engagement in this critical discourse. Let us continue on our journey towards a more vibrant and sustainable agricultural future for our country in the Philippines. So, if you ate today, thank, thank a farmer. I'll see you again on my next video lecture. God bless everyone.